One of the greatest things about Mortgage Coach is that we can use a strategy that I like to call sharpen the pencil. So when we meet with borrowers for the first time and we're just talking about fictitious properties and price ranges and estimated taxes, we can get that borrower pointed in the right direction. But until we have an actual property under contract and we know what the settlement date's going to be and we know if there's any seller assist and we know how many days we need to lock the loan, the amount of accuracy that we can provide is good, but it's not perfect. So we're under contract right now with a couple, and these folks are buying their first home. So we want to try to sharpen the pencil. So what I did was initially I had offered them 3 suggestions, and product 2 in the middle had their interest rate at 7.125. It had their payment at just around $2,043 with about $23,000 to close. What I wanted to show them was that they had some other options, and what we could do is we could look at what might happen if they wanted to bring slightly less or slightly more money to the closing table and how that might affect their payment if we looked at different interest rates. So I put this report together. We know that they're planning on being in that house for a minimum of 3 years. And we also know that there's a good chance that within the next 5 years, there's a possibility that rates would come down. Nobody knows for sure. But if they do, they're going to refinance. So what we want to do is project what things are going to look like over the next 3 to 5 years. And by doing that, we're able to show them that right now, with the product that they're in, they're going to save about $1,400 in interest over the first 36 months compared to going to a slightly higher interest rate, but bringing less money to closing. And then vice versa. If we go to a lower interest rate, they're going to save possibly another $500. But in order to save that $500 in interest, they're going to need to bring more money to the table to the tune of about $3,000. So now they have something that they can compare and say, okay, is it worth saving $80 a month and maybe another $500 in interest to come up with an extra $3,000? Or would we prefer to keep that $3,000 so that if something comes up down the road, we can be our own bank and we don't have to worry about coming up with that money? So that's the sharpen the pencil strategy. It's really hard to do that until you have a particular property in mind. But that's what makes Mortgage Coach so awesome, is that we can start out in a very abstract manner with our prospects. And as they get closer to settlement, we can hone in on those actual numbers and give them the ability to be part of the conversation. If you have any questions, you can reach out at andyloan.com.